Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now in September, Nifty touched a new peak of 20,000. Sensex too touched a new high. But what do all these numbers mean to you and me as investors? What does it mean? Should we change our strategy of investing with these changing numbers? Well, we'll talk about that and much more in today's episode. And joining me is Dhirendra Kumar. Now, first of all, Nifty touched 20,000 in September. There were celebrations around it, and it has been hovering around that numbers ever since. What does it really mean? 19,000, 20,000. Tomorrow it might touch 21,000.
Nifty is not some abstract thing. Nifty is, the underlying of Nifty is 50 companies. The proportionate ownership of 50 companies in a certain ratio. And those companies, lot of people, lakhs of people get up every morning to do their job and go and do their job, deliver something for their customers, produce something for the customer. Maruti makes cars, TCS serves people all over the world, and that is the business. And that is, there is a real thing underlying it. And they make money. Are they making more money? Will that grow faster? And I think that is the way to look at it. If those businesses are going to grow faster, if they are making enough money in relation to the price, which is the market cap of all these companies, I think one should be looking at it from a very objective lens, that assuming Nifty was a company, and it was making money, I will be looking at it how fast it is growing, and what is the price of all these companies. If I had the money to write a check and buy all these companies 100%, what does it mean? So it means like this: the value of all the companies in Nifty adds up to 1 crore 33 lakh 11,797 crore. It is this bigger number, very difficult to fathom this.
Yeah.
And all these companies put together make something like 6,32,585, for sake of simplicity, 6,33,000 crore a year. These 50 companies, whether it be State Bank, whether it be Tata Steel, whether it be Maruti Suzuki, or all those 50 companies of Nifty, Reliance Industry, and so on and so forth. All this translates into a nearly 5% earnings yield. And this profit after tax is after paying taxes, after charging depreciation, after the company spends money in earning that. There is a real cost of people, material, money, right. Interest cost, and after that you make some profit. After that you pay taxes, then you pay interest, then you pay taxes, and then after that, whatever is left for shareholders as the owner of these companies is that, which adds up to this 6,33,000 crore on a market cap of that much, which translates into an earnings yield of 4.8%. 5% earnings yield in a country of the 50 largest companies, where they are growing by 8%. And last year they grew by 54%. So this is the way to look at it. How do they stack up? Is it value for money? Are they growing enough? And if these things are in place, and most of the company in Nifty are, of course, you have outliers. There are companies growing by 100%. There are companies which are slipping by 50% on the profit. But all of it adds up to, majority of the companies are still in double-digit growth. And double-digit growth after a year when everything grew by 50% is very comforting. Market is not alarming. It's a nice round number. Feel happy, but don't celebrate. In the short run, it means nothing. In the long run, you have to see that, valuation and fundamentals, they are very well intact.
Okay, and what about Sensex? Sensex also?
Similar story.
Yeah.
Similar story, older index, so higher value. And the complexion and the character of, or if you look at the constituents of Sensex, constituents of Sensex is a subset of Nifty. And the underlying character, or if you look at the broad dynamics of Sensex and Nifty companies, is not very different. It's somewhat similar. This is a nicer, larger, even bigger, larger number, but it was invented in 1978, and this was created in 1990 artificially and got really NSE started in 1994 operationally full bloom. So that is why It's just a function of age.
How long before it touches 1 lakh?
Oh, 1 lakh from here for Sensex is not a very significant thing. Because one has to understand, must have a sense of magnitude, sense of proportion, sense of percentage. 50,000 to 60,000 is 20% growth. And 60,000 to 1 lakh is, 40,000 on 60,000 is what you have to make.
Yeah.
If all the optimism gets translated or moderately translates into reality, then because there is a whole India story tailwind, which means that companies will keep doing well, they will grow, they will do better. And in that situation, if this has to go up to 100,000, 1 lakh at Sensex, it will 33%. So I would expect that in a fast-growing company, in a fast-growing economy, it should be 2.5 years.
Okay, that's
ambitious.
something.
That looks ambitious.
Yeah.
And that could be even bigger reason for celebration, though it may not be, because 20,000 to 40,000 was a big deal. The Sensex touched a high of at 4,000 level on Sensex in 1992. And that 1992, but that was 3 decades ago. And 1992, great Indian scam, Harshad Mehta, market went ballistic, and it went up from 1,000 points to 4,000 points in a matter of 3 years. And that was a big deal, 300%.
Right.
Now that 4,000 to after going up and down, opening of the economy, many companies dying, many companies surviving, new companies coming into being. So a decade of the turbulence and a new post-reform Indian economy or the corporate sector emerging, post-liberalization. And then the market touched 4,000 level once again, 10 years later, in 2004.
Right.
10 years, nothing happened. It touched a high and again touched a high. That time it was because of the whole turbulence in the economy, the liberalization, most companies were going under, they're not competitive enough. Today we have a situation where companies are competitive. We are getting back on track. We are getting back on track with our manufacturing. Companies are growing, and we have far greater degree of optimism. What I was saying is that 2004, it attained a level of 4,000. And then in another 5 years, it went up 5 times to 20,000, what I was referring to 2004 to 2008, and it achieved a number, a bigger, nice number of 20,000. And then global financial crisis, all the struggles, ups and downs. So 60,000 to 1 lakh, it might look like a big deal, but it isn't.
So the way you put it, the valuations are not very expensive. And in such a scenario, what do you think investors should do?
Investors should do 3-4 things very carefully and diligently and do it with belief. And there are 100 things they should not do. I will not get into 100. I'll try and list a couple of them.
Yeah.
Basically, they're behavioral things. But 2-3 things which Indian investors should do is they should believe in equity. They should believe in diversification because we don't know what will work, what will not.
Right.
And diversification means, accepting the fact that you don't know everything. You will keep getting surprises in market. Then embrace the madness of the market. Because because at this level, markets will be very turbulent. It takes years to go up, and then 5 days, it'll come down very sharply and it'll scare you. So do it with belief. Everybody thinks that they have to be successful on a short-term basis as well, continuously on a daily basis. That is not going to happen.
Right.
And embrace that, reconcile with it. And if you're not comfortable, then look for steadier vehicle like hybrid fund, aggressive hybrid or conservative hybrid. Because if you are deprived of equity, you will not benefit from the India story as and when it unfolds, and the tailwind which is clearly visible in numbers as well. And then comes, don't get into over-analysis. Most of the people I come across, when I tell them equity, then they get into another confusing state that index fund, active fund, flexi-cap fund, mid-cap fund, small-cap fund, and the numbers will take you in all directions. Just do something and do it well. Do it diligently. Even if you invest in small-cap fund, you are not at great risk. Because if you are doing it for 10 years, everything else will be sorted. If you are doing your aggressive hybrid fund, it will be sorted anyway. It's a fairly conservative thing. Because, when we think that small cap is risky, yes, it is. But for 10 years, for your SIP, it's not risky. You are investing in 50 small companies. Maybe the risky thing will be when you invest lump sum in a small cap today, after it has gone up. But today, if you think in terms of what is happening, if you are going to invest for next 10 years, and assuming a constant sum of money, 10,000 rupees every month for next 10 years, this is one of the 1/20th. It is 1 out of 1/20th that you are putting.
Yeah.
It's not a risk. In fact, if it is bad luck, then it will be risk for a while, and after that you have every reason to be optimistic, because look at the 10-year return of the small cap funds. SIP return will be 23%, and point-to-point return will be 20%, and you will have 50 reasons to worry why you should not be investing.
All right, so embrace equity and stay the course. That's the gist of our conversation. That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.